Hello, dear ones. Welcome to the CA Cafe, where we serve taxes in simple lingo. Now, this is part 2 of our Budget 2023 series, where we understand the following 3 questions. What is the new surcharge? What are the changes in capital gains exemptions? And what is the connect between interest on housing loan and capital gains computation? Now, see, with respect to these questions, all the budget changes, right? It can be told in just one line. But what's the point of that, right? We need to understand what are the underlying provisions or the sections of the law. And only then these budget changes can be appreciated. So that is the purpose of this video, to understand in depth what are the underlying sections of the law so that these budget changes makes more sense. So let's move on to the first question. What is the new surcharge? Now, first, what is surcharge? Surcharge means it is a tax on tax. It is like an additional tax which is payable over and above the income tax. Okay, so it is levied as a percentage of income tax. Now, when I say surcharge, are you able to look at the big picture? Where does surcharge actually fit into the whole scheme of things in income tax? For this, I thought, let me just put out the flow of calculations in income tax, right? To show exactly how the tax calculations happen and where surcharge comes. So for any income tax calculations, this is typically are the steps that we have to follow. The first step would be determination of the residential status of the person. The person is like the assessee, the person whose income is getting assessed to tax. So residential status, it varies. Like for an individual, it could be something, for a partnership firm, something, for a company, it is something else. But from an individual perspective, it is like a resident, or he is resident but not ordinarily resident, or he could be a non-resident. Now, for any assessee or any person, the second step would be, once the residential status is determined, second step is you have to classify their income. Okay, so person can earn income from different sources, but whatever income he gets, income tax categorizes under 5 different heads. Either it can go under salaries, or it can go under house property, or business profession income, capital gains, or other sources. So these are like the 5 heads of income. Now, once the total income, whatever a person earned, it gets categorized into these 5 buckets. The next third step would be, we have to compute income under each particular head, applying the tax provisions. Because you might say, I got salary of 1 lakh rupees, but income tax says, okay, there are some deductions, there are some exemptions. No, some things are not allowed, some are deemed to be income. So many things are there for every head of income. So those provisions have to be applied to arrive at what exactly is the income under each head as per income tax. Then the fourth step would be applying the clubbing provisions. For example, a couple, they have kids, minor children, who are earning some income. But because the kid is a minor, it won't be assessed to tax. So that minor child's income will get clubbed with either of the parents. Basically, whichever parent is earning more income. So that is known as clubbing provisions. That step will happen next. Next is step 5, set off carry forward of losses. So income tax allows loss. Suppose in the preceding financial years, business or professional loss was there, capital gains or some loss was there, house property may be some loss, salaries, of course, there cannot be a loss, it is just a salary income. So those losses, income tax says you carry it forward, take it forward to the next year and you set it off, you minus it from that next year's income, subject to some rules and all that have to be followed. So that is that set off carry forward of losses will be the next 5th step. Then 6th, after doing the first 5 things, 6th step we get one figure, one value. Now that is known as gross total income. Now on this gross total income, we apply some deductions. That is called as Chapter 6A deductions. So here, my friends, basically, all the insurance premiums, medic-claims, ATG, donations which you do to different institutions, education, tuition fees of children, and, ATDD, interest deductions, bank interest deductions, so many such deductions generally, which, the investments which we do, which is allowed as a deduction, everything comes under this Chapter 6A. So those deductions is step 7. Those all we have to reduce from that gross total income. Then step 8 is we get another resultant figure. So basically, gross total income minus all the deductions of chapter 6A equals one resultant figure. Now that is known as the total income, or it's called as the taxable income. So after all these steps, now do you see we have now arrived at taxable income. This is the taxable income. Now step 9, on this taxable income, the income tax rates are applied to calculate the income tax. Now income tax we've arrived at. On that income tax only, the surcharge rate is calculated. The surcharge is calculated. So after all these steps, now if you see in all this, at the end only, the scheme of things, surcharge comes on this income tax. So this is just to give a big picture about where it fits into the whole scheme of things. Now, let's move on to what are the rates of surcharge. All right. See, surcharge, when you say, it is not one direct straightforward rate, okay, 10%, 20, 25, whatever, on any kind of income for any kind of assessee. No. Income tax law, it prescribes different rates for different situations. Now, just look at this tabular table or this information here. Here, when I talk about, the surcharge, I would like to talk two terms. First is there is some generic income which a person earns, and there are some specific incomes, because the surcharge, it talks about some generic income and some specific income. Now, let me just elaborate. Specific income is what? You should know that to understand these rates and how it is applicable. So, specific income means, suppose a person earns a dividend income. So, you buy equity shares of a company. So, the company pays some dividend. So, there's a dividend income. So, that is one type of specific income. One more is capital gains, which is chargeable to tax under section 111A, 112 or 112A. That means what? What are these three sections? It's basically, again, investments, okay? Suppose a person, he has equity shares, or a person, he holds mutual fund units which invest in equity shares, or a person, he holds units of business trust. So these are all certain types of assets. I'll call it capital assets. When it is sold, the person can earn short-term capital gains tax or long-term capital gains tax. So some capital gains, some profit he earns on the sale of these capital assets. So this capital gains or this kind of profit or the income which he earns with respect to these equity shares, mutual fund units, etc., that is also called as specific income. So I hope I'm clear here. Specific income means just these two categories: dividend incomes or the capital gains with respect to these specific capital assets. So basically those equity shares, mutual fund units, business trust units. Okay. Now we'll move on to the upper part of this slide with respect to the rates, because we have an understanding of what is specific income, and of course anything apart from this becomes some generic income. Now, where is this 10% surcharge rate applicable? The total income of the person, it can be anything, including even the specific income. Total income, whatever he is earning. If it is more than 50 lakhs for that financial year, but it is up to rupees 1 crore, okay, then surcharge will be 10% of the income tax, okay. Next, when is that 15% coming? This 15% is the second box, which has a black outline, as you see in my slide. Here is the total income, what the person is earning, including the specific income. If it is more than 1 crore, but it is up to rupees 2 crores, in that case, it is 15% is the surcharge. Now, some twist will come. You see the third rate, which is 25%. Here they say total income without the specific incomes. That means a person is earning some amount, okay. You exclude the specific incomes, that is the dividend income, capital gains on that equity shares, etc., right? That specific income and all, you remove it. Balance whatever the generic income he has, no? If it is more than rupees 2 crores, then the surcharge is 25%. Same situation, total income without the specific income. That is only that generic portion which is there, the other incomes. If it is more than rupees 5 crores, then the surcharge rate is 37%. Now, I look at that last 15% where I've put that green outline box. Here, it says, see, the total, all the income that is put together of a person is more than rupees 2 crores. Okay. In this case, the surcharge rate is 15%. How is this possible? You see that earlier 15%, when that 15% surcharge is coming, when the total income, including everything, specific also, it's more than 1 crore but up to 2 crores. It is 15%. But in the last green box, if you see, it is more than 2 crores. The total income, all the incomes put together. But still surcharge is 15%. How is that possible? That is because the law says in this situation, that person's, okay, whatever non-specific income he has, like the generic income, that is still less than rupees 2 crores. That is still less than rupees 2 crores. So because of that, that means suppose that person is earning 3 crores, of which 2 crore 50 lakhs is that specific income. It is specific. So balance, the minority portion, okay, 50 lakhs, it's less than 2 crores. Yes, that 50 lakh rupees is the generic income. In this situation, though for this person everything put together is 3 crores, his surcharge rate will only be 15%. So that is the reason to understand surcharge, we need to understand how much portion is the specific income and how much is the balance. Then only we'll be able to apply the correct surcharge rate. Alright. Now, what has happened in budget 2023? Everything has remained the same except, you remember the 37% where that, that generic income portion means that specific income ella illada, only the generic income which is there. If it was more than rupees 5 crores, that person had to pay surcharge of 37%. The budget said, don't make it 37, I will limit it to 25%. So, the 37% has been capped, has become 25%. So, basically the 37% has been removed. So, that is the change that has been brought about in this budget 2023. And one more point here is, for this 37% to be, become 25%, right? The person, that individual or that assessee, he has to pay tax under the new tax regime. That is one catch. Only then, if he is subject to surcharge and his total income is more than 5 crores, then even then he will be taxed with a surcharge of only 25%. About new tax regime, I had discussed about it in my part 1 of the budget 2023 series. So that will give more explanation about what is the new tax regime. Now, I just want to ask, add one more point here, friends. See, we told so much about these surcharge and the rates. Do you know from where all this is flowing? Where is it coming in? Is it through the Income Tax Act or from where all of the above is coming in? It is actually coming in through the respective Finance Act. Meaning, every year once the budget is presented, the finance bill is then passed by both houses of parliament. After that, it gets the president's assent. Only then the bill actually becomes the Finance Act. And through the Finance Act, all the income tax rates, including the surcharge, are imposed on us. So that is one thing I thought I had to add here. So this is about the surcharge. Now let me just go back to the previous slide. I just wanted to tell one more point here about the surcharge. See, now these rates which we saw here, is this applicable like to all assessees, whether it is company or partnership firm or individual or HUF, etc.? Actually not. What rates I've just discussed with you are applicable only for individuals, HUF, Hindu Undivided Families, Association of Persons, Body of Individuals, Artificial Juridical Persons. So if there are other assessees like companies or partnership firms, there are different rates of surcharge. In fact, even association of persons, if that association consists of only companies as its members, even then these surcharge rates are not applicable. So there is a different set of rates. So that is one more point to keep in mind. Now, considering this, now we'll move on to the next question. I hope the surcharge part was clear, and considering that, now I'm moving on to the next question. What are the changes in capital gains exemptions in this budget? See, before we understand the capital gains exemptions, I would like to tell one thing here. There are about 6 to 8 exemption notifications, exemption sections are there, okay, with respect to capital gains. There are 2 sections which have been subject to changes in this budget, that is section 54 and section 54F. But before we understand more in detail about these sections, we have to understand certain terms with respect to capital gains tax per se. That means how capital gains arise. If capital gains arise means there has to be a capital asset. If capital asset is there, there will be a cost of acquisition. There's been some cost to purchase that asset. And then once that capital asset is sold, then only capital gains comes. So that means there is a net consideration at the time of sale. And with all this, some capital gains arises on which capital gains tax is applied. We'll just try to understand, okay, these basic terms with respect to capital gains. Then we'll understand the conditions on these exemption sections. Now, capital asset. See, capital asset, it can be any asset whatsoever that the assessee owns. He can have land, plots of land. Many people have buildings, any kind of property, shares, jewelry, works of art, basically any asset, okay? But it cannot be stock and trade. See, what is stock and trade? It is like a business has inventory. That inventory is for everyday buying, selling, continuously. There is a rotation. It is not kept for a long-term benefit. It is continuously rotated. Bought, sold, bought, sold. That is what happens in stock and trade. But this is a capital asset. It is not for trading. It is held to get benefits over a period of time. So that is the difference. So capital asset is anything except stock and trade. Next is cost of acquisition. What is cost of acquisition? In very simple terms, it basically means the purchase cost. What did we pay to purchase that capital asset? And then comes net consideration. Suppose that capital asset is sold. There is a sale value. That sale value is called as net consideration. And capital gains. Capital gains is nothing but the profit on the sale. Net consideration minus the purchase cost or the cost of acquisition. And now whatever capital gains or the profit we get on the sale of the capital asset, it is subject to capital gains tax. Now the capital gains tax, the rate, it depends upon whether it is a short-term capital gains tax or a long-term capital gains tax. Now, understanding each of this in detail, definitely I have to put up a separate video because it's extremely, it's a complete big subject on its own. So that is the reason this is like a bird's eye view of some keywords, okay, with respect to capital gains. With this, it will help us understand those exemption sections. Now, coming to the first exemption section, which is section 54. Okay. Now, section 54, exemption means what? That we understand, right? Basically, suppose we have an asset, we are selling it. When we fulfill certain conditions which are mentioned in this section, the capital gains tax need not be paid. It is a very good tax planning methodology. That is the exemption sections. So, section 54, it says, a person, okay, he has a residential house. That is his capital asset and he's selling it. And again, let me clarify here. Person here, the eligible assessees for section 54, if they want to get an exemption, the person has to be an individual or a HF. It cannot be any other form of entity, either individual or HF. they have a residential house property and it is being sold. When it is being sold, after the person, that individual, he owns it for 3 years. That means because he has that original asset, that is that residential house, for 3 years, it is becoming a long-term capital asset. Okay. Now, when he's selling it, he's getting some capital gains. That is, there is a profit on the sale. What is he doing with that profit? Section 54 says, if he uses it to buy another residential house, or if he uses it to construct another residential house, subject to certain conditions, then that capital gains what he has earned, right? He need not pay capital gains tax. To elaborate the conditions more, he has to buy another residential house, I said. When he has to buy? He has to buy it within 2 years from the date of sale of his original capital asset. That is that first residential house. Within 2 years, he has to purchase. Okay. But law also allows, suppose 1 year prior, 1 year before the date of sale also, if he bought, it is fine. You can appropriate that towards the capital gains what you're earning now. So it can be 1 year prior also to the date of sale, or 2 years from the date of sale. A new residential house has to be purchased. Suppose he's constructing the house. Okay, law gives a little more time. Within 3 years, okay, from the date of sale, he should have constructed a new residential house. Now, what is the quantum of exemption if all these conditions are fulfilled? How much exemption he gets? So that original residential house that individual had, right? When he sold it, he got capital gains. If he invests that full capital gains for a new residential house, that full capital gains is exempt. Otherwise, what is the cost of the new residential house? To that extent, it is exempt. So basically, whichever is lower, capital gains reinvested or the cost of the new residential house, whichever is lower, that much is the quantum of exemption. One more condition is there. Now, the new residential house which he has purchased, he has to own it. He must hold on to it for at least another 3 years. That means it has to become another long-term capital asset. 3 years he has to hold it. What happens if that condition number 8 is not followed? If that is not followed, whatever capital gains it was originally exempted, right? That will become taxable in the year of sale of this new house. Yes, that's how stringent these conditions are. But if this is followed, no tax to be paid on that capital gains. Section 54, these are very, very commonly, adopted sections for capital gains exemptions. All right. Now there is another point to section 54. See these two categories what I've mentioned here. One is, suppose when he sold that original capital asset, original residential house, if the capital gains earned is more than rupees 2 crores, it's a very straightforward route. Just invest in one more new residential house. One more new residential house. Fulfill all the conditions. Exemption. You got it. That's all. But look at the other category. Suppose capital gains in that when he sold that original house, right? The capital gains he earned was up to rupees 2 crores. That is up to rupees 2 crores or less than that is the capital gains earned. Law gives actually two options. You invest in only one more new residential house, fine. Or why don't you invest in 2 new residential houses? So whatever capital gains you're getting, you invest in 2 new residential houses instead of one, the law says. So even if you purchase 2 new residential houses or construct 2 new residential houses, section 54 exemption is still available. Okay, but one little catch here is, if that individual, he now opts as saying, okay, I've got so much capital gains, I want to buy 2 new residential houses, and he goes for that option, right? Later, when he sells those houses, he can never think of saying, okay, I'll again reinvest in 2 more new houses. That option is gone. This option to invest in 2 new residential houses, it is available only once in the lifetime of the person. Okay? Later in the future, He can only go 1 to 1. So sell 1, buy 1, sell 1 or buy 1, something like that. I hope these points are clear. So that is the condition when the capital gains is only up to rupees 2 crores. Alright. When it is more than 2 crores, it's very straightforward. Only one more new residential house he can invest in. Right? So this is about section 54. Now let's move on to section 54F. This is the other capital gains exemption section where the budget has brought in some changes. See, I have to tell you a nice distinction which is there between section 54 and 54F. Okay, 54 it says the individual has a residential house, he's selling it and buying another new residential house. So can you see, sell and buy is the same type of capital asset, right? But in section 54F, it's just the stark opposite. The individual or the HF. See, again here also the asset is individual or HF only. That individual or HF, what he's selling, that original asset, right, what he's selling, it can be any asset, okay? It can be any capital asset except a residential house, okay? If he's selling a residential house, you cannot come under section 54F at all, because it says you sell any capital asset but not a residential house, okay? So that is the first condition, stark distinction between section 54 and 54F. Other conditions are pretty much similar. Whatever asset he's selling, it has to be a long-term capital asset. And reinvestment part, where does he have to reinvest? It has to be reinvested to buy or to construct a new residential house. So selling can be any capital asset, but buying has to be, or constructing has to be a new residential house only under section 54F. Again, the conditions are the same. Buy within 2 years from the date of sale, or even 1 year prior to the date of sale you could have purchased, and say that, hey, this capital gains what I sold now, I used it for 1 year prior purchase. It can be appropriated that way. Or construct a new residential house within 3 years from the date of sale. That is also possible. And one more important distinction between 54 and 54F is, in 54 it said the capital gains what the person gets is getting reinvested. Okay, but in 54F, it is the net sale consideration. So that means when he sold that capital asset, whatever it could be, he sold for some value, right? That value, that sale value has to be reinvested is what section 54F says. So the quantum of exemption is also in that way. Suppose the new residential house, its cost is more than that net sale value, right, of that original asset, whatever he sold, then entire capital gains is exempt. If not, suppose the cost of the new house is less than the net sale consideration, how much capital gains is exempt? Proportionately. Proportionate means you have to put a ratio. Cost of new residential house divided by the net sale consideration. In this ratio, the capital gains will be exempted for that individual or HF. Okay. Now, other conditions pretty much the same. Whatever new residential house he's purchasing or constructing, he has to own it. He has to hold on to it for at least 3 years from the date of purchase. It has to be a long term. It has to become a long term capital asset. Otherwise, what happens? The new residential house, whenever he's selling it, within the 3 years, that year, originally whatever capital gains was exempted for him, no, that will become taxable later. So that stringent, that much punishment is there under 54F also. And there's one more unique condition in section 54F. It clearly says that individual HUF, right, he has to own only 2 houses, only 2 residential houses. That means he's buying one new house. Along with that, one more house he can own. That's all. Not more than that. And this condition he has to fulfill up to within, if he cannot make an additional purchase within 1 year from the date of sale of the original asset. And he should not do an additional construction within 3 years from the date of sale of the original asset. Okay. That means original asset we have sold. And with up to 1 year, only 2 houses he should own. After 1 year, maybe he can purchase one more residential house. And if he's going to construct up to 3 years from the date of that original sale, only 2 houses, 2 residential houses. The new one what he's constructing, and maybe one more he can own. After 3 years, he can have any number of houses. Why this condition is there? Maybe they want balanced housing for everybody, but this is the condition which has to be fulfilled. If that capital gains exemption, we have to get. Okay. So this is section 54F. Now, we saw both these exemption sections. Now, what changes have been brought in this budget 2023? That is very important here. See, before telling the change, I want to tell you what was the objective of those two sections, exemption sections, section 54 and 54F. Income tax law brought in those two sections to mitigate the acute shortage of housing and so as to give impetus to house building activity. But then the department of the government observed that many high net worth assessees are there, right? Those ultra rich people. They were using these provisions to claim exemption by purchasing very expensive residential houses. Okay. So it was actually defeating the very purpose of these sections. So to prevent this, the budget 2023 has imposed a limit that the maximum deduction that can be maximum exemption, let me put it that way, that can be claimed under section 54 and 54F. Either of these sections is only rupees 10 crores. That means what? Suppose the cost of the new residential house is more than rupees 10 crores. Okay. It will be deemed that its cost is only rupees 10 crores. So the exemption is limited to only rupees 10 crores. This is about the capital gains exemption, the through sections and the budget changes. Hope I've been clear here, and now we are moving on to the next question. What is the connect between interest on housing loan and capital gains computation? Okay. Now, we saw how capital gains, that means the profit on sale of a capital asset, how it is computed. Sale value minus the cost of acquisition, correct? Now, cost of acquisition, what is the meaning? Generic meaning is the purchase cost. Suppose cost of acquisition, suppose there is it's a house property, okay? And we are to purchase that house property, we have taken a housing loan. We are paying interest on that. Interest also is an expense for us. So, for that house property, along with the purchase cost, can I add even the interest on the housing loan as part of my purchase cost? The law now, the budget has clarified the position saying, housing loan interest, you can take it as part of your cost of acquisition only if you have not deducted this expense earlier under any other section. See, income tax law gives the benefit of expense deduction, correct? That means because it's an expense, I'm allowing you to deduct so that you don't need to pay tax on that portion. So, if this this benefit has been already deducted earlier under any other section, then again you cannot get the benefit of that interest expense under cost of acquisition also. So that is what has been clarified. Double deduction is not possible ever. No double benefit. That's what this amendment talks about, or this budget change talks about. Now, just to clarify a little more, interest on that housing loan. Where is the other possible deduction? It's basically house property if a person is getting any rental income. So rental income, when he calculates, he can always minus the interest on the housing loan what he's paying fully. So there the deduction happens. One more possibility is again that house property, suppose it is not rented out, it is self-occupied. The individual or the person, he himself is staying in that house. Then also interest on housing loan deduction is allowed there also. But limit is there up to rupees 2 lakhs per annum. In some specific cases, it rupees 30,000. Okay. So these are the two situations where possibly the interest could have been deducted earlier. In that case, when that capital asset or the house property is sold, right, and you from the sale value we minus the cost of acquisition, there in that cost that interest also cannot be included. Basically, the simple funda here is double deduction or double benefit is not allowed. Okay, so that is the main thing. Well, I hope this is all clear. So what have we actually looked into in this video? The rates of surcharge and what is basically the surcharge in the whole scheme of things and what changes budget brought about. And the capital gains exemptions, section 54 and section 54F. And interest on housing loan and how is that related to the capital gains computation. Dear friends, I hope you really enjoyed this episode and followed it. And what will we be looking at in our next episode? You remember in our first few slides, we talked about that specific incomes, when we were looking at the surcharge rates. That specific incomes, right? Actually, we have to dwell a lot on what are the income tax provisions with respect to that. What are the rates? How is it taxed? It's a whole chapter on its own. So that I thought we will give a more focus in our next episode. So it will be income tax provisions with respect to the specific incomes, basically dividends and capital gains under those three sections, what you see here. Basically, capital gains when you sell equity shares or, equity oriented mutual fund units or units of business trust. Well, folks, really hope you enjoyed the episode and it was informative and useful. And do subscribe to our blog, thecafe.in. Do like this video, share with others. And until the next episode of the CA Cafe, bye-bye.